Today, we're cracking the code on Section 351 and stock basis. An S corporation lets business profits flow through to the owners, meaning the company itself doesn't pay income tax. Instead, the shareholders report their share of income, deductions, and losses on their personal tax returns. Sounds great, right? Well, it gets tricky when you contribute property in exchange for stock. Did you know that simply contributing property to your own business can create a tax bill? That's right. If you don't understand Section 351 and stock basis, you could owe taxes just for investing in your own company. Let's break it down. As I explained in my previous video, an S corporation is a business structure that avoids double taxation by passing income, losses, and deductions directly to shareholders. Instead of the company paying taxes, shareholders report profits and losses on their personal tax returns, just like a partnership. But here's the catch. If a shareholder contributes property to the S corporation in exchange for stock, that contribution could be taxable, unless it qualifies for tax deferral under Section 351 of the Tax Code. This section allows shareholders to transfer property into a corporation tax-free if three key conditions are met. 1. You contribute property, not just services. 2. You receive only stock in return. 3. You control at least 80% of the corporation immediately after the exchange. If all three conditions are met, the IRS defers taxation, meaning no immediate gain or loss is recognized. But if you fail any of these rules, you may have to recognize a taxable gain. Let's see how this plays out in real life. Alex owns a property worth $50,000, but has an adjusted basis of $25,000, because by the time he bought, that is how much the property cost. Now he contributes it to his S corporation in exchange for 20% of company stock. So, what's the problem? After the transfer, Alex owns only 20% of the company, which means he does not meet the 80% control rule of Section 351. Unfortunately, the IRS treats the contribution as if Alex sold the property for $50,000, and he has to recognize a $25,000 as taxable gain because $50,000 of fair market value minus $25,000 of its basis cost equals a $25,000 taxable gain. So what is the lesson? If you contribute property but don't own at least 80% afterward of the S corporation, you might owe taxes you didn't expect. Here is another example. Jordan, who starts an S corporation from scratch. He contributes $500,000 worth of property. The company assumes $150,000 of debt attached to the property. He receives 100% of the stock in return. Does Jordan owe taxes? No, because he controls 100% of the corporation after the transfer. Section 351 applies, making the contribution tax-free. But there's a twist. Since the company took on $150,000 of debt, Jordan's stock basis is reduced by that amount. The new stock basis equals $500,000 property value minus $150,000 of property debt, that is $350,000. Why does this matter? If Jordan later sells his stock or takes distributions, his taxable gain will be based on the lower $350,000 stock basis instead of $500,000. Why Section 351 and stock basis matter for business owners? Because S corporation stock basis isn't just a number. It affects whether contributing property triggers a taxable gain, how much tax you owe when selling stock, whether you can deduct business losses. So before contributing property to your S corporation, make sure you meet the 80% control rule under Section 351. Otherwise, like Alex, you might face a surprise tax bill. If you want more strategies like this, hit that like button and subscribe, because wealthy people aren't just born, they're made, and it starts with learning the rules of the game.